Picture this. You finally do the responsible thing. You start saving money every single month. You move $100 here, $200 there, and you feel great about it, disciplined, mature, and financially secure. But then one day, you open your banking app and notice something strange. You have $10,000 sitting in your savings account, but it's only earning 0.5% interest. That means after an entire year of discipline, you've made a grand total of $50. Meanwhile, everyone else is talking about stocks, index funds, and compound growth. And you start to wonder, am I doing this completely wrong? The truth is, saving money is essential. But saving alone will almost never build real wealth. This is exactly where most people get stuck. They know they need to transition from saving to investing, but they have no idea how to do it without risking their security. Look, savings protect your money, but investments grow your money. Those are two completely different jobs. Let's look at the math. If you leave $10,000 in a standard savings account at 1% interest after 1 year, you have $2,100. But if you take that same $10,000 and invest it in the stock market, which historically averages around a 10% annual return, over long periods, after 1 year, you'd have $11,000. That difference might look small at first, but the real magic is compounding over time. After 20 years, your savings account grows to just $12,200. Your investment account, it explodes to over $67,000. Same starting money, completely different reality. The biggest wealth gap isn't between savers and spenders. It's between savers and investors. So why doesn't everyone just invest? It's not a math problem. It's a psychology problem. Saving feels safe because the numbers don't move. Investing feels terrifying because markets fluctuate. And seeing your balance drop on a random Tuesday scares people away. But you don't have to leap blindly. The transition should happen in clear, controlled stages. Step 1. Build an emergency fund. First, before you invest a single dollar, you must have 3 to 6 months of living expenses saved in cash. This money stays in a savings account. It's not for opportunities, it's for unexpected emergencies. A rock-solid emergency fund protects your investments from your own life, so you never have to panic sell during a market dip. Step 2. Separate your money mentally. Think of your cash as 2 distinct buckets. Bucket 1 is your safety money. It does not move. Bucket 2 is your growth money. It is allowed to fluctuate because its only job is long-term expansion. This simple mental shift instantly kills investing anxiety. Step 3. Start incredibly small. You don't need thousands of dollars to begin. Most modern platforms let you start with as little as $50 or $100. The goal of your first few months isn't to make massive profits. It's to build the habit of investing. Step 4. Focus on simple investments first. Avoid the trap of day trading, complex options, or speculative crypto. Keep it simple. Look at low-cost index funds that automatically track the entire stock market. Instead of betting on one company, you are instantly diversified across hundreds of top companies. Even Warren Buffett heavily recommends this approach for average investors. The most powerful wealth strategy is actually incredibly boring: consistency. If you automate an investment of just $300 a month at an average 8% return, after 25 years you will have roughly $285,000. The crazy part? You only actually contributed $90,000 of your own cash. The other $195,000 was generated completely by compounding growth. Think of it like this. Saving money is like storing seeds inside a sealed glass jar. They are safe, they are protected, but they will never grow. Investing is taking those seeds and planting them in the dirt. At first, it looks messy, and you won't see results overnight. But over time, they take root, weather the storms, and grow into something massive. When the market dips, long-term investors don't panic. They stay calm because they look at decades, not days. They know that lower prices mean their monthly contributions are just buying more shares on sale. Ultimately, saving money gives you stability, but investing gives you true freedom. The sooner you combine both, the faster you change your financial future.